All right, welcome back, everybody. Today is Friday, Wednesday. We finished up the slides for Chapter 4, so we've gotten through all the content on Chapter 4, which is dealing with the general fund and the special revenue funds. So what I want to do today is just take a few take some time out and just to go through a few of some common entries that we could see that's going to be accounted for within these two types of funds. Let me go ahead and turn this on. I'm sorry. Um, so we might get out a little early today. We might not. Just see how things are going. See how we move through the content. Let's see if that pops up here. All right. Okay, let's see here. So what I want to start with is just do a quick little review, which obviously everything we're doing is a review. We're just kind of just getting more familiar and practicing a little bit today. I want to just start with this chart right here. Okay, so this chart right here is dealing with interfund transactions, okay? And before I get started, let me just say that everything that we're going over in class today is directly from Chapter 4 in the text. So I don't know if you all have read it or not, but it's a really good chapter. It really explains how these entries are made and why they're made. But let's just start with this. We'll start with this little chart here, reviewing a little more on some interfund transactions. So let's just start out with the top one here, the interfund loans. So we can see here it start out with the interfund transaction on the left, and then moving to the right, it gives you the description next, and then the example of the journal entries that both the fund making the payment and the fund receiving the payment is gonna make. So for an interfund loan, so interfund loans, resources are provided from one fund to another with the expectation they'll be repaid. Remember, a loan, obviously, we're only loaning it. We want our money back. So the fund making the payment is going to debit due from other fund and then credit cash, right? Because the due from the other fund is an asset. It's a receivable. It's treated like a receivable. And then obviously cash going out, we're crediting that. So just look at the terminology here, what it says below that. It says if the loan is long term, it's going to be advanced to other funds instead of due from other funds. So that's the timing issue there on what it's going to be labeled. So if it's current, it's going to be due from other fund, and if it's long term, advanced to other fund or due from other funds. The fund receiving the payment is going to debit cash and then credit due to other funds. So pretty simple there, right? They're receiving the money, they're crediting, showing they owe the liability. Same thing, if the loan is long term, advance from other funds is used in place of the due to other funds. Pretty simple, right? Interfund services. The most common examples are services purchased by a governmental fund from an internal service or enterprise fund, right? So the fund making the payment is going to debit expenditures and then credit cash, obviously, because they're receiving a service. So we're incurring an expenditure, crediting cash out. And if the fund receiving the service is a proprietary fund, expense is used in place of expenditure, right? Because we know the governmental funds operate on what type of accounting?
Modified accrual.
Right. So they recognize expenditures. They incur expenditures, whereas proprietary funds operate on what type of accounting? And they recognize expenses, right? Um, so the fund receiving the payment for the service, obviously they're going to debit cash and then credit operating revenue charges for service. Pretty simple, just like in the for-profit sector, right? For the interfund transfers, remember the big thing between sticking out between the interfund transfer and interfund loans is the interfund transfers. The money is being transferred without the hope that we're getting without wanting the money back. Right? We're merely just giving that money to the other fund. We're transferring it over there, not loaning it. So the fund making the transfer is going to debit other financing uses, transfers out, and then credit cash. And obviously, the receiving fund is going to debit cash and then credit other financing sources, transfers in. Right? Pretty good on that one. Interfund reimbursement. In an interfund reimbursement, one fund initially records a purchase that belongs in another fund. So The fund receiving the payment, we can see here, the first one here, the one actually doing it, making the payment. Expenditures is going to be debited. Cash is credited because they incurred that expenditure, right? What in the world just happened there? The whole thing just shut off. Oh, apologize about that. That was weird. Oh, I know what it was. It's because it kicked me out. Hold on, let me just back out of here. Apologize about that, everybody. I was just timed out, so it kicked me out of the material. I hate when stuff like that happens. Okay, I apologize about that. Okay, so the fund where the purchase correctly belongs reimburses the fund that made the payment, and the paying fund reverses the initial entry, right? Because remember, the initial fund that paid for that service, where it originally didn't belong, incurred that expenditure and paid cash. So what it's going to do now is the fund where it actually belongs is going to make that expenditure and then credit the cash. If the fund is proprietary fund, expenses used in place of expenditure. And then the fund receiving it, obviously, the one that had made the original payment on it is going to debit cash because they're getting the money back, and credit expenditures to reduce the expenditure that was incorrectly recorded in the beginning, right? So pretty good on the difference between interfund transactions, between interfund loans, interfund services, and interfund transfers and interfund reimbursements, right? So interfund loan, what do we expect? If we're given an interfund loan, what are we expecting? What does that mean?
You're loaning money from another part of the government.
Right, we want our money back, so we're going to set up a due from, right? So and then a due to from the receiving. The interfund transfers, what's different about that than from the loan?
You don't expect your money.
Right, we're just giving it to them, right? So it's a use, it's a financing use at the source, right, to the receiving and the paying the fund that's transferring it. The reimbursement, a fund is paid for it, and either part of the expense is theirs and part of it's not. So they want to get back the money from that expense wasn't the part that wasn't theirs, or all of it might not have been theirs. So they're going to get it set up a due from, right, and ultimately, the firm that paid it will reduce the expenditure and get the money back on the back end of the entry. And obviously, the interfund services is like exchange-like transactions. We already know that. One fund's incurring either an expense or an expenditure, and the other fund is recognizing revenue, right? So pretty good on that. Okay. Okay, so the next thing I want to do is get into some examples of how some entries are going to be made, and we've already went over how like some entries are. Obviously, we just went on some interfund activity, whether it be in reimbursements or loans or transfers or whatever it might be. So now I just want to focus a little more on just going back through recording the budget and then just some transactions that'll happen throughout the accounting period within these types of funds. We're not going directly how the book ties into it. We're going to kind of just spot it and just read the actual example and the journal entries, just so you can kind of get a gist of some material being thrown at you and seeing how it be journalized. So that's the whole goal of today's lecture really is just to get more familiar with seeing these journal entries with some data being thrown at us. I'm not really worried about tying the trial balance from the beginning of the period or the actual balance sheet from the beginning to that of the trial balance at the end. I think it would be a good idea for you all to read the chapter and try to see how it moves through it and set up through the T accounts. I just don't really want to get into that today because I don't really want it to really confuse anybody. I want to try to keep it simple and focus more on just the entries today. So with that being said, let's start by looking at recording the budget. Here in the book, and like I said, just bear with me. I'm going to kind of just pick out some data to read it, and then we'll kind of just explain these journal entries. It says at the beginning of the fiscal year 2020, the village records the general fund budget, and assumed estimated revenues is going to be 6.2 million, right? So we've debited the estimated revenues control of 6.2 million. And then it says appropriations are 5.2, right? We know appropriations are credited when we're setting the budget, so we credited the 5.2 there for appropriations control. And then it says a planned transfer to the debt service fund is 204,000, and a planned transfer to establish an internal service fund is 596,000. So obviously the 596 and the 204 equals 800,000, right? So those two transfers is going to be what makes up the estimated other financing uses control of 800,000, right? Because of the transfers, and we know the interfund transfers is the entry is made with the uses, right? So that's why we're using the estimated other financing uses control as the credit in this entry. And obviously, right here, this is a smaller budget. There's not a lot of other items that is being accounted for here. So obviously, the next thing is going to be to just to find out what the budgetary fund balance is, which is a plug figure, right? It's the difference between the debits and the credits. So not bad, right? That's just setting the budget, but it's just showed you a little bit of how I was talking earlier in the course about how some of the items within the budget could be itemized underneath an actual title here, which is the estimated other financing uses control. We seen there were two items that were included within that, so there was two items under there, right? The two different transfers that made up for that amount. Okay. Okay. Next thing, this is reestablishing encumbrances from the prior year. So pretty much at the end of last year, remember in the slides from Wednesday, remember if there's encumbered funds, encumbrances are what type of accounts? Remember we have budgetary accounts and we have the operational accounts and stuff. So the encumbrances are budgetary accounts, remember? So what do we have to do with those budgetary accounts at the end of the period?
We have to close
We have to close them, right? So obviously, if we're reestablishing this encumbrance at the prior year, we've closed $45,000 down, or we unencumbered them at the end of the prior year, right? So now we're just reestablishing it, right? So what do we do? We just re-encumber them. And it's nice to just kind of put in parentheses prior year, just so you can keep up with it for later on when you unencumber it. So we label it as prior year, we re-encumber the prior year's encumbrances, and then just set back up our budgetary fund balance reserve for encumbrances, right? Simple, not bad. Budgetary accounts, encumbrances is one of them. We know it has to be shut down at the end of the year, or closed at the end of the year, so we have to open it back up. So that's what we've just done. Pretty simple, right? Okay, the next is recording prior year property taxes as revenues. So obviously, this is the year after we've deferred them, right? So now we're going to count them as revenue. So obviously, let's back up. Let's go to last year. If it's deferred, why would we defer revenue? What justifies it being current or deferred?
If we expect to get it more than 60 days after the end of the fiscal year.
Right. If we get it within 60 days, it's current, right? If we get it outside of those 60 days, it's deferred. So obviously, $20,000 of what we thought was going to be revenue last year was actually deferred. So how do we actually defer that revenue? We know when we levy property taxes, we had originally counted as revenue, right? Because we debit taxes receivable, set up our allowance, and then the remainder is is counted as revenue, right? So we've accounted as revenue. So if we want to move it to deferred revenue, what entry do we need to make in the previous year?
Would we just debit deferred instead of taxes receivable?
Well, what you're on the right track because so the original entry when we counted as revenue. Remember, we debited the asset of taxes receivable and then credited the revenue and then credit the allowance, right? So we've counted that as revenue. So let's say 20 of it isn't revenue. So revenue is an original credit, right? So if we want to reduce that, what do we need to do with that credit? We need to debit it. So the entry to move it from revenue to deferred revenue is what in the previous year?
From revenue to deferred, would that be debit taxes received?
No. Because we're only concerned with revenue. We're moving it from revenue to deferred revenue. Revenue is an original credit, so to reduce revenue, we have to do what to it?
We have to debit.
Right, because revenue is an original credit. So there's our debit. That's half the entry. And then what do we have to do? We have to put it. Where are we moving it to?
Deferred revenue.
So there's our credit, right? So it's just simple. Remember that debit credit. So that's the entry they would have made the previous year. So now this year, we have to count it as revenue, right? Because we know we're going to collect it after the 60 days, but now we're in the next year. So now we have to count it as revenue again, right? So then, therefore, that's why now we're debiting deferred inflows property taxes, right? And then crediting it back to revenue. So we're just reversing it again, just like encumbrances. It's just easy. Just don't think too much into it, okay? It's really not bad. So if we're moving money from the previous year from revenue to deferred revenue, what's the entry?
Revenue to deferred revenue, then we're going to debit revenue and credit deferred revenue.
Right, deferred inflows, deferred revenue, and then the next year when we move it from deferred revenue to revenue again, what do? We just reverse it. Awesome. So makes sense, right?
Yeah.
Okay. Okay. Next, dealing with the tax anticipation note payable. Okay. So remember, we talked a little bit on Wednesday about sometimes governments have cash shortfalls and stuff, and they might have payrolls or some current liabilities that they need to go ahead and pay, right? So with the governments being able to have the power to levy taxes, then banks are pretty likely to go into business and do short term loans with these governmental bodies. Um, so in this case, we're actually going to be receiving a tax anticipation note of $200,000. So obviously, if we're getting cash is an asset, which assets are original debits in the entries, right? So we're debiting cash. Cash is going up, and crediting tax anticipation notes payable, which is short-term liability. So we know it's credit, right? So easy entry there, right? So that's how we record a tax anticipation note payable. And this is just going to be dealing with the payment of liabilities as recorded. And once again, don't really get into the amounts here. Let's just assume these numbers right now. Although they do tie in, if you read the chapter, you can see how the debits and credits are increasing and decreasing. But let's not really worry about that right now. Let's just assume these numbers right here. So it says checks were drawn to pay the accounts payable and the amount due to the federal governments as of the end of the previous year. So we're just assuming these amounts. So obviously, if we're paying off accounts payable, we have to debit them, right? Because it's original liability. Liabilities are original credit, so we're reducing it, so we're debiting it. So we're debiting accounts payable. And the due to the federal government, obviously, if we owe the money, if we're the original entry, we maybe got cash, the credit had to be due to. Due to is a liability, so we're debiting it here, same as accounts payable, and then cash because we paid them off, right? Obviously, the 135 and 30 make 165, so we're in balance here. Makes sense? Same thing, just paid off some liabilities, right? Only difference is we're just not used to seeing due to federal government and our for-profit side of the county, right? Okay, Issue purchase orders. So in this thing, it says in addition to the 45,000 encumbrance outstanding at the beginning of the year. Remember, we re-encumbered that 45,000 previously. Purchase orders for materials and supplies are issued in the amount of 826,000. So the general ledger entry to record encumbrances for the purchase orders is going to be a debit of encumbrances control of 826,000 and credit to the budgetary fund balance reserved for encumbrances for 826, right? Because wow, we're just ordering the goods, right? We don't have no liability; they haven't been delivered to us. We're merely ordering these goods, so we just have to encumber the funds. Why do we encumber the funds?
To make sure that we don't spend them later.
Right, because we operate and for government. What's really big in government?
Budgets.
Why is the budget really important?
It's
Because of the accountability of the government. Because they're using tax money for a lot of the just the mandatory taxes and stuff. So they have to be accountable to how they're using that money. And I'm doing that, like I said, I'm just trying to make you grasp the concepts better. So we've encumbered the funds, right? Easy. We've ordered that. We encumbered the funds. Okay, we're going to record a property tax levy, right? So remember, at the beginning of the year, we're going to levy taxes. The government, once again, they have the power to levy taxes. So we know property taxes is a huge, one of the biggest sources of money for governments, right? So in this case, it says assume the gross amount of the current property tax levy is going to be $3,265,306. Sorry, I can't read today, apparently. After considering local economic conditions at the village's tax collection policies, it is estimated that 2% of these taxes will be uncollectible. So with this entry, so obviously the whole tax levy, if you notice, is being debited, right? Because that's the whole entire taxes receivable. We're gonna debit for all the whole entire tax levy for all of the 3.265 million, right? And some change. And then if you remember, when we levy taxes, we have to set up an uncollectible account, a reserve, right? Same as trade receivables in the for-profit. When we set up the accounts receivable, we have to set up an allowance for doubtful accounts. So that way the AR is carried at net realizable value. Same concept here with taxes receivable. We debit the gross amount of the taxes that we levied, credit the uncollectible. In this case, it's 2% of the 3.265306. Which is 65,306. How do we get 2% of that? What's the formula for that? Just to make sure we understand how to get that.
and multiply it by 0.02.
Right, 0.02 times that. That'll give us our allowance. And then obviously the remainder of that is what's going to be the revenues controlled. So pretty much here we have a receivable of taxes receivable in the full amount. We have our allowance for uncollectibles, and we've counted this as revenue, right? So we've levied the property tax. So that's the entry that would be seen. So on the exam, if I would give you, okay, taxes that were levied in this amount, X amount is considered to be certain percentage to be uncollectible, you can make this entry right here. Okay. Okay, this is going to be dealing with the collection of delinquent taxes. So it says delinquent taxes are going to be subject to interest and penalties that must be paid at the time the tax bill is paid. Obviously, we know that if we don't pay a tax on time, we're going to have interest and penalties because of it. So I just want to make sure that everyone understands that's where these interests are coming from. When you're late on taxes, you incur interest and penalties. The government should accrue the amount of penalties and interest at the time that the taxes become delinquent. So once the taxes go from being current to delinquent, that's when they start accruing this interest and penalties, right? Interest was accrued at year end in 2019 and must also be accrued for the period from the date of last recording, the date when the taxpayer pays the delinquent taxes. So from the date it becomes delinquent to the date they pay it is when those penalties and interest are going to accrue, right? So it says in the current year, the Village of Riverside collected delinquent taxes in the amount of $330,000. Of this amount, interest and penalties of $20,000 had been accrued at the end of 2019. Okay, Further, $3,000 additional interest was collected for the period from the first day of 2020 to the dates on which the delinquent taxes were collected. So let's look at the entry here. Let's just break this down here a little bit. So 8A, entry 8A records the additional interest as revenue. So if we recall, there was $3,000 of additional interest that was collected for the period from the first day of 2020 until it was paid, right? So that $3,000 right here is the current year, from the beginning of the year to when it was actually paid. So what they're doing here is you're going to accrue that amount from that period. So obviously we're going to debit interest and penalties receivable of $3,000 and credit revenues control, right? So now we've accrued that as the interest and penalties receivable, and we've counted as revenue. Then 8B records the collection of the delinquent taxes and the total interest and penalties owed. So obviously we're getting cash in the amount of $353,000. Of that, $330,000 was taxes receivable, and the other was interest and penalties receivable. Because if you recall, it was $20,000 that accrued in interest and penalties from the previous year in 19. The $3,000 we just accrued here. So that's why the interest and penalties receivable was $23,000, and the other one was the taxes receivable. Makes sense? Not bad, right? Okay, the next entry right here just deals with the collection of current taxes. It says collections of property taxes levied is $2.7 million. And it says since the revenue is recognized at the time the receivable was recorded, taxes receivable is going to be credited, obviously, right? Because revenue's already been accounted for, right? So therefore, when we're receiving payment for the taxes we've already levied, we're going to debit cash, right? Because it's an asset, it's going up, we're debiting it. And then we're going to credit taxes receivable, right? Because we've already counted it as revenue, as it said. So we credit taxes receivable. Why are we crediting taxes receivable there again?
To lower it.
To reduce the asset taxes receivable on the balance sheet, right? Because we know it's not at 3.5 anymore. We've collected 2.7 of it, or whatever the original amount was. We've collected that amount of it, so we have to reduce it by that amount to keep it intact, right? To keep our assets intact. Let me ask you this. What the overall position of the government for this entry, has it changed their financial position within the company? Has it changed from this entry here?
Not really. You're trading one asset for another.
Right. That was a little trick question. I just wanted to see your thought press on it. Overall position has not changed. You just one asset went down, the others, and it's went up by, it's a complete change. So the overall position, if looking at the balance sheet, hasn't changed. It's just more liquid now because you just have the more liquid form of an asset, right? So, but the position hasn't changed. Good job. Okay, let's see what this next one is. This is other revenues. So right here, this is dealing with sales tax. So it says, assume the retailers must submit sales tax by the 10th of the following month to the state government, and the state pays the local governments their share within 30 days. So the merchants say in January they make sales. Whatever they sell, that sales tax is due, it's saying here, by the 10th of the following month. So by February, that's due to the government agency, right, the one collecting that money. Then that government agency, then from that point, has 30 days till they have to remit it to the other governments, right? So during the year, 1.35 million of sales taxes resulting from 2020 sales are received by the village from the state government, okay? An additional 60,000 resulting from sales during the final week of 2020 are expected to be received in January 2020, or January 2021, I'm sorry. So obviously, sales taxes were received of 1.35, so obviously that's cash. We know we got that amount of money, so we're going to debit the 1.35. Of that, 60,000 resulting from sales is still be expected to be received in January. So we're going to say due from state government for 60,000, right? And then we're crediting revenues control for 1.41, right? Why did we debit revenues control for the whole 1.41 instead of separating and putting 1.35 as revenue and then the other 60 as the deferred revenue? Why did I do that? Because it says where we're going to see the rest of those taxes are expected to be received in January, right? So that falls within the 60 days, right? So we're counting it as revenue. If it would have said we weren't receiving it till March, it would have been deferred inflows, the property taxes, right? Or sales taxes. Make sense?
Yeah.
So that see how just a little attention to details right there that available, measurable, and available really come into play because you can get your revenues out of whack between reporting periods. So just little cues like that to look for, right? Just time frames when the dates are pertinent, which we know that dates are of great interest to accountants because of all the elements we have to account for with interest and different time periods and everything, right? So not bad here, right? We got the cash. We're receiving the receivable. The receivable is going to be due within the 60 days of next year, so we're going to count it all as revenue. And what we do, what they paid us, what's due to us, it's all going to revenue. Oh. Okay, and the next this is dealing with just more other revenues. Revenues from licenses and permits, fines and forfeits, intergovernmental revenue, charges for services and other sources not susceptible to accrual or recognized on a cash basis. And it says collections for the year are 1.45 million. So obviously we just cash revenues control, right? Because we just did it. We did, like I said, it's recognized on the cash basis. So obviously we're not accruing anything. We just got the money in. It's when the cash changes hands. So that's when we counted the revenue, right? So we just got that money from fines and forfeits. Because obviously we don't have to accrue for those. You know what I mean? They happen when they happen. So when that happens, the money comes in, counted as revenue.
And I'm just checking somewhere else. You're going to be more specific where that money came from, right?
Yeah.
On the different statement.
Right, on a different statement, because like right here it's just telling us, because that's the control account, right? Like cash, we don't care because cash is cash. Cash will be one, but that's the control ledger, right? The general ledger, the control ledger. But then in the subsidiary ledger, yeah, you'll have where the revenues came from. In this case, it says from licenses, permits. So with underneath, you're right. Good job pointing that out. So underneath the revenues control there, and in the subsidiary ledger, it would break down the sources of revenue. So, and like I said, in this case, it would say licenses for the X amount, permits, fines until it adds up to this total. So good job. You're absolutely right. Because we want to know revenues are by source, right? We want to know where it's coming from. So in order, and it makes sense, we have to show the subsidiary ledger has to show where the revenue is by source, because if we didn't, then when we looked at the actual statement of revenues and expenditures and changes in fund balance, it would only just say revenues control, and it'd just be one big number. We'd have no idea where it came from. So it'd be kind of hard to judge and make predictions on what your revenue is going to be if it's just all compiled there. But it's easier for us to say, okay, well, revenue is that. But if we want to get particular about it, we just go to subsidiary ledger or the statements, which is obviously we build the statements, so it's important to account for it by itemized details. So yeah, good job pointing that out. Repayment of tax anticipation note. So if you recall, remember we borrowed $200,000. We debited cash, credited that tax anticipation note. Remember we were a little short on cash. We had some payrolls we had to pay. Well, now we're paying that note back. Main thing here when you're paying those back, if you recall, the principal is what? It's just washed, right? We're debiting the original principal because that's what we borrowed. But what do we do with the interest? How do we account for that?
It's an expense or an expenditure.
Right, because that's what it cost us to get that money, right? And so that's going to affect our budget, right? So we have to count that as an expenditure, and obviously cash is credited for the difference. So when we pay back that note, we just debit the original note. If we're paying the full amount back, we're assuming we are. We paid that full $20,000 back. Interest in this case was $5,000 for whatever the period was. So expenditures control. So we know this is a governmental fund that did the tax anticipation note payable and then credited the cash, right? And most of these short-term tax anticipation notes payable will be seen within the governmental funds. But in case it is within internal service fund or something like that, you're right, it would be an expense as opposed to an expenditure. So main thing, just count the interest as the expenditure and expense. The other is just a wash from the debit will wash out the credit or the relative liability. Next is recognition of expenditures for encumbered items. So here it says some of the materials and supplies ordered last year and this year were received. So remember, we had some orders last year, that 45,000, and then we ordered some more. The 821, I believe, is what it was. So invoices for the items received totaled $820,300, and they related to purchase orders totaling that totaled $821,000. Right. So we received the invoices were $820,300, but when we made the purchase and encumbered the funds, it was for $821,000. Right. After we inspected the goods and services, the invoices were approved for payment. Since the purchase orders had been encumbered against the appropriations, it's necessary to reverse that. So let's just see here. So obviously, the amount of goods, the invoice was $820,300, right? That's the actual invoice amount, but it was it related to $821,000 that was ordered, right? So therefore, we have to unencumber the $821,000, right? Because that's what was the order. So obviously, we know we debit the budgetary fund balance, reserved for encumbrances, credit encumbrances control, right? So now we've unencumbered the funds. We're back to square one. And at this point, we know we have a liability, right? Because now we've actually received the stuff. So now we set up the expenditures control. If you notice here how we say prior year, see why it's important to kind of denote what you want or for what period it relates to, so you can kind of keep track with whatever the expenditures are. So we know this expenditure right here was from the prior year, $45,000. Expenditures control for the current year, $775,300. Accounts payable, $820,300. Remember, because that's the invoice amount. Because remember, the encumbered amount is what it is when we place the order, and it could be the same or different on the actual invoice. But we have to unencumber what was pertaining to the order, what we received. In this case was $821. That's why we unencumbered it. But the invoice was actually for $820,300, in which $45,000 of it pertained to the expenditures control for the prior year. Not bad, right? Same thing. So it's this whole expenditure cycle with modified accrual. Nothing's changed. It's just now we see the element of there's an element of the prior year is a piece of it. Not bad, right? You encumber them when you order them. You unencumber them when they come in. You set up your liability, right? Okay, so the next is dealing with payrolls and payroll taxes. So it says the gross pay of employees of general fund departments amounted to the $3,345,000, so $3.34 million, right? And you notice it says employees of the general fund departments because that's for the general operations of the government, right? So it's coming out of the general fund for $3.345. The Village of Riverside does not use the encumbrance procedure for payrolls. The gross pay is charged against the appropriations of the individual departments through a subsidiary ledger, which is not presented here. Deductions from gross pay for the period amounted to $78,000 for employee state income tax withholdings and $686,000 due to the federal government. Of that, $430,000 for federal income tax withholdings and the other $256,000 for employees' share of Social Security and Medicare taxes. So we know when we get our paycheck, we have our gross pay, right? Then we're going to have our federal income tax coming out, our state income tax, Medicare, Social Security, right? So that's what we're talking about here. So when the state cuts that check, obviously the full payroll for the gross amount has to be debited as expenditures control, right? Because it says that the full entire payroll amounted to 3.345, right? So that's our first. The start of the entry. We're going to debit expenditures control for the entire gross amount of the payroll, because that's what the expenditure is for us, right? Due to the federal government of 686, of that it's the federal income tax withholding, Social Security, Medicare, right? Because it's coming out of their check, so it's not ours. It's coming out of the check, but we owe it to the federal government, so it's a due to. due to the state government of $78,000 for state income taxes being withheld. So we owe that to the state government, right? And then wages payable is the difference. Obviously, that's the amount that's going to be paid. That's their net pay. So that's the employee's net pay. That's a liability as wages payable. But then we're going to go ahead and pay the employees too, right? Because it's the payroll we're doing. So we'll debit wages payable of 2.581, and then credit cash of 2.581. So let's just talk about this just for another second. Total gross payroll was 3.345 million, right? So we debit that whole expenditure because that's what we incurred. That's how much that payroll cost us. We know we have some liabilities because we pulled some money out that was theirs earned. They earned it, but they have an obligation to pay taxes. But we act as the agent or the fiduciary people and actually pull it out for the state and federal, right? We withhold it out of their check. But then we're liable, so we're setting up liabilities to the relative governments. The federal, for the federal income tax, like I said, Medicare, Social Security, all at the federal level. State income tax withholding, wages payable. So we've set up all of our liabilities, right? We've incurred our expenditure for the gross payroll, but now we've set up where we owe all the money that's included within that gross expenditure to the federal, state, and to the employees. Next, we pay the employees, so we reduce that liability and pay cash, right? Makes sense? So it's kind of cool seeing how companies deal with the back end of the payroll, right? So you see it coming out of your check, but then you see what they have to do with it on their back end of it. Okay, so the next one here is going to be just that this is going to be a payment of the actual liabilities right here. So it says the village is liable for the employer's share of Social Security and Medicare. So if you recall, I don't know if you're how familiar you are with payroll law and stuff, but employers have to match Social Security and Medicare, right? So if it's $50 per employee, they have to match $50 per employee, right? So it says here the village is liable for employer share of Social Security tax, Medicare tax of $256, and for contributions to additional retirement funds established by state law. And we're going to assume that amount is $167,000 for the year, right? Because we also know employers, whether they be private sector or governments, a lot of times sponsor retirement accounts in which they match a percentage of their gross pay, right? So that's what they're talking about here as far as the retirement funds here. They're matching. So this is all the matching concept here, matching the responsibilities of the Medicare, Social Security, and retirement accounts. So obviously that's going to be an expenditure to the government because they have to go over and beyond and match it. So it's coming out of their resources, right? So we're going to debit the expenditures control for the 423, which is obviously the 256 for the due to the federal government for matching the Social Security and Medicare, and then the 167 to the state government for the retirement accounts that they're responsible for. So it makes sense. Same way we did on the other entry. It's just now this is the other entry with the payroll. We're setting up the employer's responsibility. The other stuff was dealing directly with what employees performed with. This is the employer's share, but it's set up the same way, right? Okay, payment on account and other items. So it says payment is made on $770,000 of the outstanding accounts payable, and the amounts due to the state and federal governments are paid in full. Okay, so now with the examples we just went through, due to the federal and state governments, we pay those in full. So obviously it says payment of $770,000 is made. So we're going to debit accounts payable of $770,000, right? Because it said we paid all those accounts off, and this says we also paid off what was due to the federal and state governments, right? So we're going to debit the due to those as well of 942 and the 245, which is the stuff that's relating to the payrolls, the match, and what came out of the employer's checks, right? And then the accounts payable is just other items, but we're paying it all at once. So we're debiting all those liabilities, right, to reduce them, right? Then we're crediting cash because the asset's going out the door. It's reducing our balance in the cash account. Makes sense. We just paid liabilities off, just different sources. That's why they're itemized here, or line items, right? Simple enough, right? Not bad. Journal entries really aren't that bad, are they? They're still confusing. You really got to think about, because it's almost like connecting dots. You got to keep up with where you built it, and then if you're going to deplete it. You know what I mean? That's pretty much what journal entries are. You're just moving items to different parts of financial statements is all you're doing with your debits and credits, because different elements belong on different statements. And you know, I mean, that's all it is. You're just pretty much connecting dots and moving items around is all it is. So we understand the payroll entries and then paying the stuff off. So correction of errors is what this is dealing with. In this case, what the city did is they accidentally they sent out two tax statements. So in this case, they sent out duplicate $1,200 tax bills, right, to some of the people out in the city, some of the residents. So how do we correct that? Obviously, if we've sent out a duplicate of $1,200 statements, then revenue is overstated by $1,200, right? So therefore, if we want to reduce revenue, remember we just debit it because revenue is an original credit, right? So we're debiting it and then crediting taxes receivable. So and that right there does away with it, right? Now we're back intact. Revenues are back down to where they should be, and our asset of taxes receivable are back where they should be, right? That's how we correct the error.
Would we ever have to undo estimated uncollectible taxes?
I'm actually about to get to it. Yep, that's actually. I don't know if we'll get to it today, but yeah, you actually have to, just same as uncollectible taxes, have delinquent taxes, the associated interest and penalties with those taxes have to be removed as well. Because if you remember, interest and penalties are derived from late taxes. So obviously, if we remove the late taxes off the book, we have to remove the accompanying interest and penalties. So yeah, that's really good thought process. A lot of people don't even think of bringing that element in with it. But yeah, if it relates to it, then it has to go off the books as well. Like I said, we won't get to it today, but we'll definitely get to it on Monday. We'll wrap up these examples Monday and probably start chapter 5 Monday. But yeah, good thinking on that. So we're good here correcting the error, right? We accidentally sent out two bills, so we reduced revenue, we reduced our receivable of taxes. And this will probably be our last one. This one or the next one will be our last one. Okay, this one here, this is another good example. We made a mistake on the last one, right? So now we need to amend the budget. We've done this before, if you recall. We've looked at an example within our PowerPoints. Let's say here, we won't even have to, I don't even have to read what it is because we can tell what it is. So we know on the original budget, when we set a budget, this will be our last slide. When we set our budget, what's the entry? Don't even look at this. Just tell me what the entry is when we set a budget.
We set a budget, it's estimated revenues.
It's a debit.
It's a debit. And then we have other financial sources.
Yep, which is a debit. Estimated other financing sources.
And then we have appropriations.
Which is a credit.
And then other financial uses.
Right.
Is a credit, and then the plug is the budgetary fund balance.
Awesome. Yep. That's how you record the budget. So now, since you just told me that, what's this journal entry doing? We're adjusting the budget here. We're amending the budget, but what's this journal entry accomplish?
We have 50,000 more revenues than we thought we would.
Right. Why? You're right. Because think of the original entry. It's an original debit, right? Estimate originals. So if we're seeing that again, revenues are expected. We're getting more money than we thought we had. So you're right.
But then also the appropriations are more than we thought by 100,000.
Right. So therefore,
the difference
is the 50, and we know
less.
It's the plug to the budgetary fund balance. So in essence, we think we're going to get 50,000 more revenues than we originally thought we had. We have to appropriate more than we thought we had by 100,000. So our budgetary fund balance now has reduced by 50,000 because of the estimated revenues and appropriations. This makes sense, right?
Yeah.
Not bad at all, right? So, and that's all I have for today. And we'll get into some more transactions on Monday and hopefully start chapter 5 as well. So just everyone remember to work on the Connect assignments. And I think they're due, chapter 3 is due this week, I think. So make sure to get those in, and then if you have any questions, just shoot me an email or something, and I'll see everyone on Monday. Well, I appreciate your time. You still okay with everything?